Welcome back to Talk Tickers. This is the deep dive where we do the heavy lifting for you. We listen to the hours of earnings calls, we scour the 10Ks, we parse through the press releases, and we read those tiny footnotes that the investor relations teams desperately hope you just ignore.
Right, because we listen to the calls so you don't have to.
Exactly. We are the premier earnings call summarization service for the serious market participant. Our job is simple. We cut through the corporate PR fluff to find the actual signal in the noise, and we deliver that alpha directly to you.
And I am definitely ready to dig in today. We have a ton of ground to cover.
We certainly do. Today, we are turning our attention to a ticker that has been making some serious noise on the tape lately. And I have to be completely honest with you. If you had asked me about this company maybe 2 years ago, I would have probably rolled my eyes. I would have put them in the, the cute but irrelevant bucket.
Yeah, I think a lot of the street did the exact same thing.
Absolutely. So the company is DigitalOcean, ticker symbol DOCN. If you haven't looked at this name in a while, your mental model is probably stuck in that 2021 or 2022 timeframe. You're probably thinking about that friendly little blue shark logo.
The developer sandbox.
Right. The cloud for hobbyists. The place where I go host my personal WordPress blog for $5 a month. You're thinking it's just a sandbox.
That is definitely the vintage view.
Yeah.
But if you actually listen to the Q4 2025 call, or if you dug into the strategic roadmap they just dropped, that mental model is not just outdated, it is actively dangerous to your portfolio. The narrative has shifted so aggressively here. We aren't talking about droplets for bloggers anymore.
No, we really aren't.
Management has deployed this completely new vocabulary. They are calling themselves the Agentic Inference Cloud.
Agentic Inference Cloud. I mean, I have to say, on the surface, that sounds like the winner of the 2025 Buzzword Bingo Championship.
It really does.
It sounds like something a highly paid consultant came up with just to juice the stock price for a quarter. But our job here at Talk Tickers is to be skeptical but remain open-minded. So we looked under the hood of this print, and it turns out there is actual architectural substance behind that slogan.
There is a massive amount of substance, and more importantly, the market seems to completely agree with the new narrative.
Let's start right there. Let's start with the tape. Because, as we always say on this show, price acts as a truth serum. You can spin whatever narrative you want on a conference call, but you simply cannot fake the bid.
No, you can't.
We saw the Q4 print come out, and usually with a high beta tech name like DOCN, if there's even a single hair on the numbers, you get taken out to the woodshed.
Instantly punished.
Right. And initially in the pre-market, we did see some of that volatility. It was chopping around quite a bit. The algorithms were clearly trying to parse the guidance and figure out what to do with the margin commentary. But as the session opened and the smart money actually started digesting the details, the stock settled into a very distinct, very constructive trend.
It was a wildly confident move. The stock closed at roughly $62.74.
Yeah.
That was moving up from about $59.24. So you're looking at a gain of nearly 6%, 5.91% to be exact.
Which is a solid session.
It is. Now, a 6% move on an earnings beat isn't necessarily front page news in the software sector. But what caught my eye, and what should really catch the eye of every serious participant listening to us right now, was the volume.
It was massive volume.
It was a staggering spike.
Okay.
We saw nearly 7.35 million shares trade hands in that session. To put that in context for you, the average daily volume for DigitalOcean is hovering right around 2.49 million shares.
So we are talking nearly 3 times the average daily volume.
Exactly. And we need to explain why that context matters. When you see a stock drift up on light or average volume, that's retail, that's noise. When you see a stock gap up and hold that gain on triple the average volume, that is not some guy in his basement buying 10 shares on Robinhood.
No, that is institutional rotation.
That is a fund manager, or frankly, several fund managers, looking at their Bloomberg terminals and saying, okay, the thesis has completely changed here. The risk profile has changed. I need to size up right now. They are voting with heavy capital.
And here is the real kicker with this price action. And we're going to spend a lot of time on this later in the deep dive. They bought the stock heavily, despite the fact that management explicitly guided for near-term margin compression.
That's the most bullish part of the tape.
Usually if you tell Wall Street, hey guys, our margins are going to go down for the next 2 quarters, they sell you off instantly, ask questions later. Here, they bought the dip before it even really dipped. They bought the news.
That tells you everything you need to know about the growth acceleration story. It is winning. The bulls are winning the argument that this is a structural turnaround for the business, not just a macro flash in the pan. The market is looking past the next 3 months of margin noise, and they are locking their eyes onto the 2026 and 2027 exit velocity.
So that is the setup. The market clearly believes the story. Now, let's look at the actual evidence they were presented with. Let's hit the results snapshot. We'll run through the headline financials quickly before we get into the real meat of the strategic analysis. Top and bottom line, how did the actual print look?
They beat across the board. Revenue for the fourth quarter came in at $242.4 million. The consensus estimate on the street was hovering around $237.7 million. So a very comfortable beat on the top line.
And the growth rate, because that's what everyone has been agonizing over.
This is key. 18% year over year. Now, I know some listeners who are used to those crazy triple-digit growth names might yawn at 18%, but you have to look at the derivative here. You have to look at the historical trend.
Right.
For a long time, the core bear case on DigitalOcean was that growth was structurally decelerating. It was trending down toward 12%, then 10%. Some bears were calling for single digits. The fear was that the business model was just stalling out completely.
The dreaded X-growth label.
Exactly. So seeing that number tick firmly back up to 18% is a massive signal to the street. It breaks the deceleration trend. It signals real reacceleration.
And on the earnings side, they also delivered. Non-GAAP diluted EPS came in at 44 cents. That handily beat the street consensus of 38 cents. So they are profitable, they are growing the top line, and they are beating profit expectations. Cash flow looked very solid, too.
It did.
Operating cash flow is at $57 million, which is a 24% margin. And adjusted free cash flow is $27 million, coming in at an 11% margin.
Those are the headline numbers. Those are the numbers that the algorithms scrape and trade in the first millisecond after the release drops. But if you are listening to this deep dive, you aren't an algorithm. You want the real metrics. The stuff that tells you about the health of the business 3 years from now, not 3 minutes from now.
So what stood out to you in this supplementary deck?
The absolute standout number for me was the organic incremental ARR, annual recurring revenue. They added $51 million of net new business in the quarter. That is a company record.
Wait, let's pause on that for a second. A company record, that beats the peak COVID era.
That beats the peak stay-at-home tech bubble era. Think about that for a second. Back in 2021, literally everyone and their grandmother was launching an e-commerce site or some digital SaaS tool. Money was basically free. DigitalOcean grew incredibly fast back then.
Right. They were a primary beneficiary of that zero interest rate phenomenon.
Exactly. But they just added more net new revenue in Q4 2025 in a normalized restrictive rate environment than they did during that massive bubble. That is a staggering statement on the underlying demand for their product right now.
And we know exactly where that demand is coming from. It's certainly not from people spinning up more food blogs.
No, it's the AI velocity metric. AI customer ARR hit $120 million. That is up 150% year over year. That is pure hyper-growth territory, and it's buried inside a mid-cap infrastructure company.
And then you have the whales. This is the other metric that just completely destroys the old bear thesis. Customers spending $1 million or more annually now represent $133 million in ARR. And that cohort, the really big spenders, is growing at a mind-bending 123% year over year.
That completely flips the script on the company. The old knock on DOCN was that they only had small customers and massive churn. Now, the absolute fastest growing part of their entire business is the enterprise tier.
So, the numbers are undeniably good. The acceleration is very real. But the deep dive today isn't just about looking in the rearview mirror of Q4. It's about looking through the windshield. It's about this massive transition to the agentic inference cloud. This is the strategic pivot that management is betting the entire farm on.
This is the most critical part of the thesis. If you don't understand this pivot, you simply do not understand the stock. You have to get this. Management specifically, Patty, the CEO, is aggressively distancing the company from being a quote-unquote GPU landlord.
Let's unpack that term for the listener. GPU landlord. We see these neoclouds popping up everywhere now. CoreWeave, Lambda, Voltage. What exactly is a GPU landlord?
Think of a GPU landlord exactly like a car rental agency for supercars. They go out, they borrow a massive amount of private equity or debt. They buy 1,000 NVIDIA H100s, the literal Ferraris of computing right now.
Right.
They rack them up in a data center somewhere, and they rent them out to startups by the hour.
And the customer essentially just gets the keys to the Ferrari.
You get the keys and a steering wheel. That's it. It's a raw, bare metal box. You have to figure out how to drive it yourself. And fundamentally, it's a commodity business. It is a race to the bottom. Because eventually, someone else will borrow more money, buy the exact same Ferraris, and rent them out for $1 less per hour. There's absolutely no software moat.
And DigitalOcean went on this call and explicitly said, we are not that.
Correct. The core thesis they laid out is that the entire AI market is shifting. Phase one of the AI boom was training. That's OpenAI building GPT-4 and GPT-5. That requires massive, ungodly clusters of 20,000 GPUs all talking to each other at the exact same time. That is a game for kings.
Microsoft, Google, Meta.
Exactly. It's a highly capital intensive. Right. And honestly, there are only about 20 or 30 customers in the whole world who actually matter for that scale of training.
And DigitalOcean isn't even trying to play that game.
No, they're deliberately avoiding it. They're betting everything on phase two, which is inference.
Let's clearly define that for the listener who might be a market participant, but maybe not a machine learning engineer.
Sure. Inference is using the model. Training is building the brain over months and months. Inference is the brain actually thinking in real time. When you type a query into ChatGPT and it instantly writes you a poem, that is inference. When an AI agent books a flight for you on a travel website, that is inference.
And the scale is completely different.
It's night and day. Inference involves millions of applications, not 20 megaclusters. It involves a scale-out architecture. You need instances all over the world close to the users. And crucially, it requires a full software stack to actually run the application, not just a raw chip-crunching math.
And they have the actual financial metrics to prove they aren't just renting chips right now. They specifically mentioned that 70% of their AI customer revenue comes from non-bare metal services.
That is the moat right there.
Yeah.
I cannot stress this enough. That 70% figure is the single most important number on their entire strategy slide deck.
Because it proves lock-in.
Exactly. It means customers aren't just coming for a cheap GPU hour. They are buying the entire stack. They are buying managed Kubernetes to orchestrate all their containers. They're buying object storage to hold their data securely. They are buying the database to manage the user sessions. They're paying for security.
So if a competitor like CoreWeave suddenly lowers their raw compute price by 10%, the DigitalOcean customer doesn't just pack up and leave, because they are entangled in that entire software ecosystem.
Precisely. They are sticky. They have built their core application logic directly into the DigitalOcean platform APIs. Moving away to save a few pennies on compute would be an engineering nightmare. That gives DOCN real pricing power.
Okay, so that brings us to the actual applications being built. They kept using this term agentic systems. This is where we need to get a little technical to truly grasp the bullish case. They define agentic systems as software that reasons, acts, retains memory, and runs continuously.
This is the massive evolution we are seeing from the basic chatbot. And this is exactly why the cloud part of Agentic Inference Cloud actually matters. Think of a standard chatbot like a goldfish.
A goldfish, okay.
You ask it a question, it answers you, and it immediately forgets who you are. It has no memory. In computer science, we call that being stateless.
Okay, so a basic chatbot is a stateless goldfish. What is an agent?
An agent is more like a digital employee. It has state. It has memory. If you tell an AI agent, hey, plan a 2-week trip to Tokyo for me, it has to go out and search for flights. Then it has to store those flight options. Then it has to go search for hotels that specifically match those flight dates. It has to constantly remember step 1 while it is executing step 5.
And mechanically, inside the actual data center, that memory requires specific infrastructure.
Bingo. Memory in computer science terms means you need a database, means you need storage volumes, it means you need a virtual private cloud network to keep all that user data secure. A raw GPU renter does not give you any of that. DigitalOcean gives you the GPU plus the database plus the secure networking all in one interface. That is why they are calling it the Agentic Inference Cloud. They are arguing that their platform, which remember was originally built for hosting complex web apps, not just doing math, is the perfect native home for these continuous digital workers.
And they highlighted the success of OpenClaw on the call to essentially prove this exact point.
OpenClaw is the perfect real-world example. It's an open-source agent framework that just went totally viral among developers. DigitalOcean noted on the call that 30,000 droplets, those are their virtual machines, were spun up in just a matter of days specifically to run OpenClaw.
30,000 servers in a few days. That is insane velocity.
It is unequivocally proves product market fit. These AI developers didn't want to go log into AWS and spend 3 days configuring IAM roles and permission policies just to test out an agent framework. They wanted to click one button and have it running in 60 seconds.
Right. DigitalOcean's legacy of simplicity, which, ironically, used to be looked down on by the enterprise crowd as just being for hobbyists. That simplicity is now a massive speed advantage for AI engineers who want to move fast.
Exactly. And they are actively building new native tools to support this even further. They just launched remote MCP support.
Which stands for Model Context Protocol.
Right. It's a brand new standard for how AI models securely talk to external data sources. By building MCP support directly into their control plane, DigitalOcean is basically making their entire infrastructure AI aware. They also launched an agent development kit. They are furiously trying to build the software tooling to take a customer from just playing around in the sandbox directly to a scaled production deployment without ever having to leave the DOCN platform.
Let's shift to the hardware side of this inference equation. Because it's not just the NVIDIA show anymore. They specifically highlighted multi-node AMD GPU support on the call. Why does that matter to the thesis? Isn't NVIDIA the undisputed king of AI?
NVIDIA is the undisputed king of training. But for inference, cost is the ultimate king. And this brings us right to the Jevons paradox that management cited during the Q&A.
I always love when tech CEOs start quoting 19th century economists on earnings calls. Unpack the Jevons paradox for us.
The Jevons paradox basically states that as technology increases the efficiency with which a resource is used, the total consumption of that resource actually increases rather than decreases. Basically, if you invent a way to make light bulbs incredibly cheap and highly energy efficient, people don't suddenly spend less money on lighting. They just start leaving the lights on all night and lighting up their entire driveways.
So applied to the AI compute market.
If you make running an AI model radically cheaper, developers will simply run far more agents. Management noted that utilizing open source models like Llama 3 running on their AMD chips is roughly 90% cheaper per token than calling the big closed models via API.
90% cheaper.
Yeah.
That is a massive spread for a developer to arbitrage.
It is a game changer for unit economics. So DigitalOcean is actively optimizing their cloud for this mixture of experts approach.
Meaning an app uses different models for different tasks.
Exactly. A modern application might route the highly complex, difficult reasoning questions to GPT-4, which is very expensive. But for the 90% of tasks that are high volume, routine data extraction or simple summaries, it routes that traffic to an open source model running on cheap AMD hardware on DigitalOcean. That optimized mix is exactly where DOCN wins on price to performance.
So they're effectively positioning themselves as the blue-collar workhorse of the new AI economy.
That's a great way to put it. If the future is billions of AI agents doing trillions of microtasks every day, you absolutely want to be the platform hosting the high-volume, low-cost workhorse models. You don't need a Ferrari to deliver a pizza.
That makes complete sense. So the technology stack is perfectly aligned with where the inference market is going. But technology is only half the battle here. You need actual enterprise customers to pay for it. And this brings us to Deep Dive Segment 2, the customer mix transformation. For years, the heaviest bear thesis on DOCN was what they call the graduation myth.
The graduation myth. I have heard this peddled by short-selling hedge funds for 5 years straight. The fundamental idea was always, DigitalOcean is just a nursery. Startups are born there because the UI is simple and the bandwidth is cheap. But the moment they actually get successful, the moment they hit scale and need real serious infrastructure, they graduate and move all their workloads to AWS or Azure.
The bears basically said DigitalOcean would never, ever keep a large, highly profitable customer.
Well, the data from this specific quarter basically puts a giant wooden stake directly in the heart of that myth. Churn for their $1 million plus customers was literally 0% in Q4.
0%. I mean, mathematically, you cannot get better than 0.
You really can't. That metric means the biggest, most technologically complex customers on their platform are not leaving. They are highly satisfied. And the net dollar retention, the NDR, tells an even more aggressive growth story.
Let's break down those NDR dynamics. Because overall, NDR was 101%, which, let's be fair, is just okay in software. But the segmentation of that number is where the real alpha is hidden.
Exactly. If you just look at the blended rate, you miss the thesis. If you look at the $100,000 plus customers, their NDR is 102%. The $500,000 plus cohort is at 106%. But the $1 million plus customers, the real whales, their NDR is a massive 115%.
Wow.
That means these massive customers aren't just staying on the platform, they are natively expanding their spend by 15% every single year. The fundamental growth engine of this company has completely flipped. It used to be that the long tail of tiny users drove all the business. Now, scaling those huge enterprise customers is the primary engine of revenue growth.
And they dropped some very specific high-profile names on the call to validate this enterprise momentum. Character.ai was the big one everyone noticed.
Character.ai is a massive, massive win for them. This is a top-tier, widely recognized AI native company. They serve millions of active users, generating billions of words. They are not some weekend hackathon project. And DigitalOcean achieved a 100% throughput increase and a 50% lower cost per token for them by deeply optimizing their workloads on AMD hardware.
That is a highly tangible, hard ROI case study they can take to every other AI startup.
Absolutely. It's the ultimate proof of concept.
And Hippocratic AI was the other major customer win they highlighted.
And that one is wildly significant for a totally different reason. Compliance. Hippocratic AI is building highly specialized healthcare agents. They're dealing directly with sensitive patient data.
Right. That is a whole different ballgame.
It requires extreme HIPAA compliance, SOC2 Type 2 certifications, serious enterprise-grade security. The fact that a company like Hippocratic chose DigitalOcean strongly validates that the platform is fully enterprise-ready. You can confidently run regulated, mission-critical workloads here now. It's not just a playground anymore.
So the product suite is working, the massive enterprise customers are staying and expanding, the strategic pivot makes logical sense. Now, we have to talk about the actual money. Deep dive segment 3, the financial physics. Management repeatedly use this term, physics, to describe their guidance. And this is where market participants need to pay very, very close attention, because the guidance was, frankly, aggressive.
It was a classic, unabashed beat and raise on their multi-year outlook. For 2026, they are officially guiding revenue between $1.075 billion and $1.105 billion. That represents roughly 21% growth at the midpoint. But the real kicker, the part that got the stock moving, was their commentary on exit velocity.
Explain that concept for us.
They are boldly projecting that by the time we hit Q4 of 2026, their year-over-year revenue growth rate will be accelerating past 25%. And for full year 2027, they are targeting 30% revenue growth.
30% growth for a company already doing over $1 billion in recurring revenue is a tremendous reacceleration. Remember, we were literally agonizing over 11 to 12% growth just a few quarters ago. But, and in financial markets, there is always a big but. This growth comes with a very real cost. Management spent a significant portion of the call meticulously explaining the physics problem of their upcoming margin compression. Let's really unpack that so no listener gets blindsided in Q1.
Right. Revenue growth at that scale isn't free. To hit that 30% target, they desperately need capacity. They need actual servers plugged in to sell. They are bringing 31 megawatts of new data center capacity online throughout 2026. The physics problem they keep referencing is simply the unyielding lag time of physical infrastructure.
Walk us through that timeline mechanically.
Okay, day 1. You sign a massive commercial lease for a new data center hall. Day 30, you start writing checks for that lease. Day 60, you have contractors installing heavy power and specialized cooling. Day 90, you finally get the servers delivered and racked. Day 120, you actually turn them on, test the network, and start selling those instances to paying customers.
So for those first 120 days.
For 4 solid months, you are paying heavy rent, you are paying for massive power availability, you are paying specialized engineering staff. But you have $0 of revenue coming in from that specific haul. The expenses hit your P&L immediately, but the revenue trolls behind by a quarter or more.
And because of the rigid way lease accounting works under GAAP, you can't just hide that upfront cost.
Exactly. Unlike buying a physical building, which you can capitalize on the balance sheet and slowly depreciate over 20 or 30 years, these data center leases are often expensed immediately as operating costs. This artificially but heavily suppresses your margins in the short term. So Q1 and Q2 of 2026 are going to look optically ugly on the margin line. Gross margin will dip, net income will take a direct hit.
And they also explicitly warned that net leverage is going to temporarily pop above 4.0x.
And that is a historically high number for them. 4.0x leverage might definitely scare some conservative credit analysts or bondholders, But management was very clear on the call. This is a temporary, intentional spike. It is a financial bridge. As the new revenue comes online and fills that 31 megawatts of fresh capacity later in the year, the leverage ratio naturally compresses right back down. It's a highly calculated bet. They are leveraging up the balance sheet to build physical infrastructure right now solely because they have the locked-in demand pipeline to fill it.
Now, despite that obvious margin pressure coming, they are still trying very hard to sell the overall profitability story. They brought up the weighted rule of 50.
Right, the rule of 50 is a classic SaaS software metric. It usually dictates that revenue growth plus profit margin should equal 50. Management claims they are on a clear path to a weighted rule of 50, where they heavily weight the growth side. Specifically, they calculate it as 1.5 times revenue growth plus 0.5 times free cash flow margin.
That sounds a little bit like, hey, we are just making up our own grading rubric because we didn't like the grade the market gave us, doesn't it?
It can absolutely be interpreted that way by skeptics, sure. It is undeniably a bit of corporate financial engineering. But if you strip away the spin and look at the underlying reality of the cash flow, their defense actually holds up pretty well. Even with this heavy, capital-intensive investment phase, their unlevered free cash flow looks very strong at roughly 18 to 20%. The levered free cash flow is lower, naturally, because of the heavy debt service and interest payments. But management's core point is solid. We are scaling growth to 30%, and we are still structurally cash flow positive while doing it.
Which is incredibly rare in this sector. Usually 30% infrastructure growth requires a massive cash burn.
Exactly. Most companies growing at that velocity are violently diluting their shareholders with secondary offerings or burning through cash reserves. DigitalOcean is completely self-funding a massive global physical expansion. That definitively shows the underlying unit economics of the inference cloud are actually very healthy.
Let's touch on the capital allocation front quickly, because they've been busy cleaning up the balance sheet to make room for this massive build-out.
They addressed the lingering 2026 convertible notes very effectively. There's only about $312 million remaining on those notes, which is fully covered by their current liquidity and projected cash generation. They also managed to buy back $82 million in stock during 2025.
But should investors expect more aggressive buybacks in 2026?
They noted the authorization is still open through mid-2027, but I really wouldn't hold my breath for a massive buyback right now. The message on the call was crystal clear. Priority number 1, 2, and 3 is organic growth investment. Every spare dollar they generate is going straight into securing more GPUs and more data center footprint. If the stock experiences a totally irrational crash, maybe they step in to defend it. But right now, capital is allocated to capacity.
They also mentioned a bit of product pruning, sunsetting a legacy bare metal CPU product.
Yeah, that's roughly a $13 million ARR hit. It will be a slight headwind to the top line number optically, but strategically, it is absolutely the right move. That was a low margin, highly commoditized legacy business. Getting rid of it materially improves the quality of their overall revenue mix. More importantly, it allows them to reallocate scarce engineering resources directly onto the high-growth AI agent areas.
All right, let's zoom out here and look at the broader investor context, the macro view. Because we've seen a lot of violent volatility in the software sector recently. The IGV ETF, which is basically the benchmark for software, has been down quite significantly over the last 3 months. There is this pervasive, creeping fear in the market regarding software disruption.
The fear is simple, and it's existential for a lot of these companies. The fear is AI agents are going to replace us seats.
Explain the mechanics of that fear for us.
Okay, think about a massive legacy company like Salesforce or HubSpot or Zendesk. Their entire business model is predicated on per-seat licensing. You pay them, say, $100 per user per month. If you have a massive customer support team of 100 human beings, you are paying for 100 individual SaaS seats.
Right. It scales linearly with headcount.
Exactly. But what happens to that model if a highly capable AI agent can effectively do the work of those humans? What happens to Zendesk if a company can replace 90 human support reps with one continuous agentic system running natively on DigitalOcean?
You fire the 90 humans.
And critically for the market, you immediately cancel those 90 Salesforce or Zendesk software seats. That is a massive structural deflationary pressure on legacy SaaS revenue. The market is absolutely terrified that AI is going to radically shrink the total addressable market for all seat-based software.
But DigitalOcean is actively arguing that they are the perfect counterposition to that macro fear.
Exactly. They are positioning as the ultimate hedge. They are the infrastructure powering the disruption. Because if an AI agent replaces a human worker, that digital agent needs to live somewhere. It requires constant compute, it requires persistent memory, it needs secure networking to run 24/7. DigitalOcean provides the exact physical housing for the specific agents that are actively replacing those legacy SaaS seats.
So they're essentially selling the picks and shovels for the AI enterprise revolution.
Precisely. If the legacy SaaS companies lose billions in seat revenue, that money doesn't just evaporate from the global economy, it shifts. It shifts directly from software license fees to raw compute and inference costs. DigitalOcean is perfectly positioned to capture that massive capital shift.
But how does their competitive moat actually hold up against the giants in this new world order? We always have to ask the gorilla question, why doesn't AWS or Google just crush them with infinite capital?
It's the most common pushback, and it's a completely fair question. Against the mega hyperscalers, DigitalOcean routinely wins on two specific vectors: radical simplicity and a guarantee of no vendor lock-in.
Expand on the lock-in aspect.
AI-native startups are incredibly wary of getting trapped. They do not want to build their entire core business logic exclusively on Google's proprietary Gemini model or deep inside AWS Bedrock. They want total architectural control. They want the freedom to run cheap open source models on raw Linux boxes without a hyperscaler taxing every API call.
And DigitalOcean is essentially playing the role of the Switzerland of the cloud.
Right. Neutral ground. You want to run Llama? Fine. You want to run Mistral? Great. You want to mix them? Go for it. And it's materially cheaper and vastly easier to configure than AWS.
And what about the other side of the competitive spectrum against the newly minted neoclouds, the CoreWeaves and Lambdas of the world?
The neoclouds are incredibly formidable if you only look at pure GPU hourly pricing. If you are training a massive foundational model and you literally just need 1 million raw teraflops for 3 months, you go to CoreWeave. But as we meticulously discussed earlier, for inference, you desperately need the full software stack. You need the managed database, the virtual private cloud, the durable storage. DigitalOcean has spent over a decade perfecting that exact software wrapper. CoreWeave is trying to build that enterprise suite from scratch right now. That gives DOCN a massive multi-year head start.
Plus, they're quietly hiring some serious heavy-hitting talent. The hiring of Vineet Kumar really caught my eye in the footnotes.
That was a huge, glaring signal to the street. Vineet Kumar isn't just some random mid-level engineering exec. He is literally the guy who fundamentally built Oracle Cloud Infrastructure, OCI. He inherently knows exactly how to build and scale true hyperscale architecture.
You definitely don't hire a guy with that resume to manage a platform for hobbyist blog hosting.
Not a chance. You back up the Brinks truck to hire him because you want him to build a serious enterprise-grade, globally distributed AI cloud. It deeply validates that management is incredibly serious about executing this vertical integration strategy.
It really is a fascinating setup right now. We have a company executing a successful strategic pivot, fundamentally accelerating top-line growth, securing massive enterprise whales, but facing incredibly noisy near-term margin pressure entirely due to the physical physics of building infrastructure.
It is the textbook definition of a show-me story. But based on this print, they are finally starting to actually show us. The violent, positive market reaction to this call heavily suggests that institutional investors are finally willing to look straight past the Q1 and Q2 margin dip, because the 2027 prize 30% durable growth and massive free cash flow is just far too attractive to ignore.
All right, I think we have thoroughly unpacked the earnings, the strategic pivot, the financial physics, and the macro disruption context. Now it is time for the segment everyone waits for.
Disclaimer time.
You absolutely know the drill. We are talk tickers. We are an earnings analysis deep dive. We are not your registered financial advisors. We are not your broker. We are literally just two disembodied voices discussing market mechanics. You must do your own thorough due diligence. Do not ever execute a trade solely based on what you hear from us today. This entire segment is for entertainment and educational purposes only. If you blow up your portfolio, please do not call us.
Okay, now that the compliance lawyers are thoroughly satisfied, let's get weird.
It is time for the "this is not financial advice" trade idea. What kind of wild scenario have you cooked up for us this week?
I am officially calling this the Agentic Alpha Trade. Or, if you want to sound really fancy at your next networking event, you can call it the Inference Spread Leap.
I really like the sound of that. Walk us through the precise mechanical setup.
The broader market is currently pricing DigitalOcean stock as a highly skeptical show-me story. They see management's 30% growth target for 2027, but they were deeply scared of the capital expenditure and the lease expense drag coming in early 2026. As a result, they're effectively treating it like a value tech stock.
Right. A mid-cap infrastructure play trading at maybe 4 or 5 times forward sales.
Exactly. So where is the massive pricing mismatch? The mismatch is that by Q3 or Q4 of 2026, that targeted exit velocity of 25% plus growth is actually going to be fully confirmed in the quarterly prints. The ugly margin compression will finally be in the rearview mirror. And historically, when a software company definitively accelerates from 18% to 25% and then guides to 30%, the valuation multiple does not just stay flat, it violently re-rates.
It migrates from a value multiple straight to a high growth multiple.
Exactly. You go from trading at 4 times sales to 8, maybe 10 times sales. The market abruptly moves you from the boring legacy infrastructure bucket directly into the premium high growth AI bucket. That is a glorious double whammy for the stock price. The core earnings go up, and the multiple assigned to those earnings expands simultaneously.
So what is the actual play here? How do we specifically express this view in the market?
Leg 1, the long. We go aggressively long, deep out-of-the-money call options on DOCN, specifically targeting the January 2027 expiration. You absolutely want to give yourself enough time duration for the physical physics problem of the margins to fully resolve and for the new data center revenue ramp to really kick in. You are essentially making a leveraged bet that in 12 to 18 months, the dominant market narrative will have completely shifted to DigitalOcean is the primary global host for AI enterprise agents.
Okay, so January 2027 gives you plenty of runway for the thesis to play out, but that is just a naked long bet. We run a sophisticated book here. We need a hedge. We need to fund this trade and protect against a broader macro tech sell-off.
Leg 2, the short. Here is where the spread part comes in. You systematically short a custom basket of legacy seat-based SaaS players. You aggressively target companies that are entirely reliant on per-seat human licensing for their revenue. Think about high-volume call center software providers. Think about basic, repetitive data entry platforms. Think about bloated legacy CRM systems.
The ultimate victims of the agentic shift.
Exactly. The victims.
Yeah.
The hyper-efficient AI agents currently being coded on DigitalOcean's infrastructure are actively coming to destroy their core business model. If the entire AI agent revolution is real, the human seats disappear and the back-end compute usage skyrockets. This specific pairs trade captures both sides of that massive capital ledger.
I genuinely love the structure of that. You are going long the core infrastructure of the digital agents with DOCN, and you are actively shorting the impending victims of those exact same agents with the legacy sauce basket. It is a brilliant macro bet on the entire agentic shift, perfectly utilizing DOCN's specific volatility and timing profile.
Exactly. If the whole AI agent narrative turns out to be a complete bust, well, both sides of the trade probably just stay flat and chop around. But if AI actually works at scale, the eventual financial divergence between these two specific asset classes will be absolutely massive.
Wild, highly plausible, and incredibly dangerous. Just how we like it here.
Yep.
Keep your eyes glued to the tape, and for the love of God, keep your stops tight. And, it leaves you with one final thought to mull over while you check the charts this week. We've talked about humans buying agents, but what happens when the AI agents get smart enough to start actively optimizing their own infrastructure spending?
Oh, wow.
What happens when an autonomous agent realizes it's mathematically cheaper to run its own subroutines on DOCN, and it just autonomously migrates the entire enterprise workload away from AWS without a human ever pressing a button? Who exactly is the customer then?
That is a terrifyingly bullish thought.
Something to think about. We will see you next quarter for the Q1 print to see if that massive margin compression hits exactly as they predicted.
See you all out there.